Welcome, welcome, welcome! What? Week 7 investments and real estate. Come on, somebody. Listen, we're going to talk some investment and real estate. Listen, I'm so excited to be here. My name is Marlon Smith, and my colleague Tony Jackson and Chris Jackson. It is so great because the momentum, the feedback. First of all, I want to say thank you. Thank you to you. So many people have enjoyed this series, and the feedback's just been incredible. So you know what we do. Type in the chat box, where are you watching from? Because we like to see which state represents. Now, can we just talk a little football? Because I know Tony's going to want to talk about it. And I only watch the highlights. I don't have time for no real all 3-hour games. But I got to tell you, man, did y'all see Seattle versus the Patriots? I'm just asking. I want to throw a little controversy up. Yo, that was so cool. I was rooting for Seattle. I'm gonna put my hand up, man. And they stuffed Cam Newton on that last play. So go ahead, type in the chat box. Did you like that game? And then what about? Was it the Cowboys lost to Atlanta? No. I'm sorry. Atlanta had a 20-point lead or something. I think it was the Cowboys they played. I'm not sure. But just type in the chat box, where are you watching from? We like to create a little drama. So, without further ado, I want to bring up my colleague in 1 minute. But I want to say this. Tonight is the night. I just read a study. They said that 90% of the world's millionaires, they basically do it through real estate. Now, I've heard another study that said 70%. But what I want to say to you is that the majority of individuals are creating wealth through real estate. Now, outside of Dubai, land is land, right? Can't make no more land except in Dubai, where they what they do. They fill up, and they're making land, right? But my point is this: real estate is a vehicle. And, one of the things I want to say is that, I don't know what your portfolio looks like, but real estate should be part of your portfolio, right? It's either, land or rental properties. And we'll talk a little bit more about that. But remember, investments and ROI, write that down, ROI, return on investment, right? So you want to make sure that you're making an investment, and then while you sleep, that investment is growing. So what are we talking about, Marlon? I'm talking about real estate is an investment. Stocks are investment. Your business is an investment. Are you catching me? So these are things that can appreciate, go up in value. And that's what the key is. You want to really be smart where your money is making money for you. So listen, we got Ohio in the house. Go blue. Chad already starting some stuff. See what Tony done did to Chad? They're gonna come by your house, Chad. And we got Sharon, you Ohio State or Michigan? My dad's from Detroit, so I guess I'm kind of, Michigan, right? But, Tony always wearing blue shirts and, University of Michigan shirts. I don't know, man. This brother is all into it. All right, but we got Denise, Illinois in the house. Hey, Denise, how are you doing? Grateful to have you here, right? And yeah, Chad said land is power. It is, I look at my grandparents, didn't have the college degree, but were landowners. And that's something I think we really have kind of missed a little bit. Here's what I'll also say, and I'll continue. Type in the chat box where you're watching. We're going to give you a shout out. I'm going to go through the list. But this weekend, I watched a mini series on Netflix on Madam C.J. Walker. Woo, man, you talk about a business mind. And I got to tell you this. Let me just tell my own story. 1991, I went to a speaker training, Les Brown in Detroit. Oh my goodness, Detroit, Michigan. All right, the Michigan connection. And I left there, met a guy, and it was a Friday, Saturday. And then that Sunday, he invited me to church. After church, went into the bookstore, and what do I see? Think and Grow Rich, A Black Choice, Dr. Dennis Kimbrough. I had read Napoleon Hill's book, Think and Grow Rich, but now Think and Grow Rich, A Black Choice by Dr. Dennis Kimbrough. Bought the book. I flew from Detroit back to, I was living in the Bay Area at that time, California. And my friends know I can throw down on food, right? But rather, I'll never forget, this is back in the day when the flight attendants come down with the cart and they give you a, tray of food. And because the words on the pages were touching my spirit, when they were coming down, I said, no, I don't want any food, because I was being fed by this book. The reason why I'm sharing this is because Madam C.J. Walker was in that, Dr. Dennis Kimbrough featured her in Think and Grow Rich, Your Black Choice. And he talked about how she took $2.02, $2.02, and became the first female millionaire in the United States of America. Not first African-American female millionaire, the first female millionaire. And so again, watching this Netflix special was like a 5-part series. It was powerful. And so the reason why I'm bringing it up is because, again, we're going to talk about entrepreneurship next week. And that, ladies and gentlemen, you want to be here, because I'm going to really come strong. Tony's going to come strong. We believe everyone should at least have a business, even if it's part-time. There's something about having something of your own. And so that's really powerful. And so again, investments and real estate. And so we're going to be talking about investments and real estate, right? Real estate is just one type of investment. But again, having a business, having stocks, we talk about IUL, Tony's going to break that down a little bit, Index Universal Life. I mean, these are strategies for how you can create wealth. Okay, so let's go back to see where we are. Chad said land is power. Thank you, Chad. And I see that with that, he said, yeah, land is power. James, okay, James is from Marietta, Georgia. Hey, James, grateful to have you here, brother. Okay, Alabama in the house, right? Go Roll Tide. Is that what y'all say? You see, I'm all excited. Okay, and then we got Ohio State. Okay, Sharon's like, yo, I live in Ohio. I'm Ohio State. Okay, don't get it twisted. Chad, yeah, he talking about Michigan. I know Tony, Michigan, UM, all right. I'm having a good time, y'all. And then we got, okay, Ebony from Atlanta, but we won't discuss the Falcons. I know, Ebony, they were up by what, 20? Please, Ebony, let me say something to you. That Super Bowl, when the New England Patriots, I was with Tony Jackson and his family. Lord have mercy. I was mad. I ain't gonna lie to y'all, okay? Tony was smiling. He's a Patriots fan. But we were together having a good time. I was like, yeah, Atlanta. And the Falcons, what was it? 23-point lead. They lost. Okay, I'm sorry. But anyways, I understand, Ebony. And then we got Little Rock, Arkansas. Man, I just saw something on Little Rock 9. That was powerful. So again, what I want you to also remember, when we talk about investments, and I'm going to bring Tony up, investments in real estate, the other thing is investment of your time. Like I said, I don't have a lot of time. I don't have time to be watching a 3-hour football game. So what I do is I just go ahead and on YouTube, you can watch the whole game, the highlights in 10 minutes. And that's what I do, just the big plays. So with that being shared, investment of your time. And the real reason I said that, because Little Rock, I watched a documentary on the Little Rock 9. And I want you to understand, the Black couples getaway, I want you to understand, you're truly blessed. We have opportunities that our grandparents, great-grandparents, great-great-grandparents did not have. And it really, we have a responsibility to go deep, y'all. I understand, entertainment, but my dad used to say, why are you watching other people live their dreams via, he used to call it idiot box, right? Talking about the television. And what I'm saying is that's why I commend each and every one of you. You are here with us right now. We're talking about real estate and investments. If you can just learn one thing, just one thing, man, the trajectory of your life and your family's life will be transformed. So that's what is so exciting. And thank you, Casey. Yes. So let's go ahead and bring up Tony. I know he's itching to get on here. And, he's probably wearing blue, y'all. Let's see. Let's find out. Tony Jackson, come on up, buddy.
Hey, no blue tonight, but I bleed maize and blue. Listen, Marlon, here's the thing, man. If you're a football fan and you're like a Will Wolverine fan or a real fan, you can't be watching the Cliff Notes version of the game. That's like the Cliff Notes version of the Real Money Coach. You're going to miss it.
That's true. Right. That's a good point, man. That's a good point.
I'm so excited. One of the reasons I'm really, really geeked tonight is I'm looking at the chat box, man. I see Ebony, I see James, man, I see Chad. These people become my friends, man. I met with them all this week. They're my friends now, bro. Come on.
Yeah.
Tonight, right?
Yeah.
So, man, I love it. Here's the thing, man. I love football. That's my one recreation is I love football. So I'm so glad the NFL is playing. I'm so glad that the Big Ten is coming back in October, mid-October, so I can just get my football fix on while I'm doing all my work, right? So,
right.
But really excited about this thing, investments, right? Because investments is so important. And I love what you said. You talked about real estate as an investment. You talked about your business as an investment. You talk about all these different things that are all forms of investments. And we're really going to just talk about that a little bit. We're going to talk about how you can invest in different things. We're going to unpack a little bit about opportunity costs and different things. And then if we really get around to it, man, we're going to talk about real estate. And I know that there's some really great people who are on here that probably are real estate investors. So if you're a real estate investor already, put that in the chat box. Let us know. Let us know what you're doing. If you're flipping properties, or maybe you're renting properties, or whatever you do, let us know if you're involved in real estate. Let us know, because it's so important. Now, we don't proclaim to be real estate agents or real estate experts, but we do know this. We do know, I'm going to tell you, I'm going to go biblical on you right now, that they told them to go and possess the land, right? Yeah. They said, possess the land. And you said, other than Dubai, that's it. There is no more property. They're not making any more land. And really, they're not making that land, right? They're bringing it from somewhere else, dumping it there. So here's the thing. If you own a piece of property, especially with, we have these things called opportunity zones, regentrification. We have a lot of stuff that's going on that's really taking the property out of the hands of a lot of our people and putting it into others' hands. And so we just really want to encourage people, hang on to the land if you can hang on to it. Keep it in your family, put it in a trust, whatever you can do to hang on to the land, hang on to it. The values will come back around. Right. And so I'm just excited about this whole thing tonight.
Yeah. And Tony, as you were just talking, I was just thinking about, land and homes, like my mom is still in the house that I think since I was 4 years old, she's still in the same house. Right. And I think one of the things that we need to do, I'm talking to the parents and the grandparents right now. I think we need to really educate our children and our grandchildren on the importance of legacy, right? I mean, the house is paid off and whatnot, and so just think about it. Another 40 years, and my mom passes away, and it comes to my brother and I, and then we're like, oh, we can make some money, But what about the legacy? And so I think it's very important that we talk to our children about investments, right? And how we can do things not for our children, but for our children's children. I love what, Casey said, right? Casey said, we stand on the shoulders of many. And I think, really, to be honest with you, in so many ways, you think about Tulsa, Oklahoma, Black Wall Street, right? I mean, all the different Black African-American insurance companies, right? I mean, you look at, BET and Essence Magazine, right? And again, they did what they did, right? But what I'm saying is, it's nothing like having these these icons, like I look at Madam C.J. Walker. I mean, so many women became entrepreneurs as a result of her vision. And I just want to say that, let's really think long-term, family. So, type in the chat box, as Tony said, are you doing real estate? What's your investments? I mean, do you do stock?
Look at this community, right? Look at this community. The Black Couples Getaway. And I'm just watching the chat box, right? So Sharon puts in, I purchased some land, a portion of my family's farmland in Alabama, wondering what to do with it. And then Casey comes in and says, hey, listen, lease it to a farmer who wants to farm it. Look at that, man. That's community where we're going in and helping. The one thing that was, when I read Sharon's comment at first, is the thing that kept staying in my mind is, whatever you do, keep the land. Keep the land, own the land, possess the land. And so I think those are all just great ideas, but it just really kind of touched me to see the two of them communicate through the chat box with a great idea. And so that's what this is all about. Each one, reach one, teach one, right? And
Right.
so, man, I love it. I love this community. These are such great people. And just to get to know them when you have these one-on-one conversations with them, man, it really is really special.
And I want to say something to that. I mean, you saw Tony just light up, right? Because yeah, and again, I want to put that out to all of you. If you haven't had your complimentary one-on-one, free, no obligation financial coaching session with Tony, I want to encourage you to do that. I mean, you can see he's lighting up. And for those of you that have had a session with Tony, type in the chat box. Was it worth your time? What did you learn? Whatever you want, you feel comfortable sharing. But really, I think we have to understand that many times there's a lot of what do you call it? There's a lot of almost like, I don't know if I can trust you. But I hope that over these 7 weeks now that you feel our passion, right? I mean, and listen, again, as Tony said, we don't have all the answers, but we have a network of individuals that have been vetted, that are very, very committed to doing things with excellence. So again, for those of you that have had a session with Tony, just type in the chat box. Was it worth your time? Did you enjoy it? Would you recommend it, to somebody else? I'd love to see what you say.
But, and Marlon, it's interesting that we're talking about real estate and land, and you're standing in front of a globe. I mean, I'm like, man, that's an awesome metaphor. It's right behind you. And so that's pretty awesome. So
thank you, man. Thank you. Yeah.
Man, let's jump into a little bit of the investment piece. What we want to really talk about is investments. We want to talk about risk tolerance. We want to talk about some of those things a little bit. And then we're going to shift. I'm going to share a little bit out of my own presentation that I do. And then, if time permits, we're going to talk a little bit about the real estate. But I want to remind everyone that all of this, except for a little piece that I'm going to do in between, all of it is in your book. It's all in your playbook. Download it. The information is getting there. It's there. And so it's we got a lot of information. And what you guys don't know is even beyond this, we also have something called the Real Money Coach University, which is actually a subscription service where you can go in and do research and do assessments on yourself and bring your own financial IQ up. And so we'll give you more information about that as we go. But let's jump into this whole thing about real estate or investments. First of all, there's some very important considerations when you think about investing. One of the considerations is opportunity cost. What does it cost me to invest? Because if you shift money from one place into someplace else, there's always that opportunity cost that you may miss out on because those funds are tied up for whatever you're doing. And then the other consideration is time. Time horizon is what we usually call it. So how much time do I have? When you're investing and you need that money to come in 5 years versus, I got 15, 20 years. So that's one of the big considerations is what type of time do I have? Do I buy and hold? Do I buy and flip? And that's where we're talking stocks, mutual funds, property, whatever it may be, even businesses. Some people, their business is to buy and hold, all right? And then buy and flip, turn it, all those type of things. And then what are your investment goals? What are your goals? What are your overall goals? What do you plan on doing? Is this a retirement? Is it for college, for your kids, your grandkids? Is it for the next generation? Thank you guys, Chad, James, Pam, thank you for the shout out in the chat box. Love you guys. And then what is your risk tolerance? And that's a very important thing because some people have more risk tolerance than others. And you guys have seen me use the little business card analogy. If you have a very high risk tolerance, then you can go out and buy the type of stocks and, because everyone wants to own Amazon. Everyone wants to own, Walmart, those type of things, Facebook. But you have to realize that when you buy individual stocks, Nike, all those things, especially given this COVID, situation and what's happening with the economy, everyone wants to buy those things, but that's where risk comes in. If you're buying a stock that may or may not go up in value and you only have one, then that's where you have to be careful. And so, and I always use the example, if you bought two stocks, right? One stock called MySpace, what would that be worth today versus if you bought stock in something called Facebook? So we have to keep all those things in mind. So there is a difference in risk tolerance. And then you have to think about inflation rates. Is your investment going to keep pace with inflation? And, I did an exercise one time where I just did a search, bank rate. I Googled trying to find the highest paying CDs in the country. And I could not find one CD that was a 1-year CD that actually outpaced inflation. And so if you're in an investment, a savings account, money market account, CD, and that investment is not earning enough to keep pace with inflation, that's just not a good long-term investment because you're losing buying power. Now, if you're in a situation where, again, looking at all the considerations, where your time horizon is much shorter, and so now getting into something safe like that makes a lot of sense. But when you got a long way to go, then you need to be a little bit more aggressive. And so, and one of the things I want to point out is when we're talking about investing, we're not talking, when we think about time horizon, most of the time we think about it in terms of age, but age really doesn't have anything to do with it, because you can be 70 years old and say, hey, listen, this is for the next generation. So your time horizon is much different than it is if you're, 60 and say, I need this for retirement in 5 years. So all those things could take into account. So it's not so much your age, it's about when you're going to use the money. And I always like to ask these 3 questions: is where the money come from, because that certainly makes a difference, and what do you want the money to do, and when do you want it to do it? And so those are very important questions, and that's really a beginning place for you to even think about when you're investing. It's like, okay, I have this money. Where'd the money come from? If that money came from inheritance, you might not want to be as risky with it because it means something. And then what do I want it to do? And when do I want to do it? So those are great, great things. So as we move on here, I want to talk again. I want to go back and just drill down a little bit on opportunity cost, because a lot of people don't realize that that's a big deal. So if my money is tied up in a certain investment, that means there's other investments that I can't take advantage of. So everything has an opportunity cost. And again, you just got to be mindful of that. Same thing when it comes to your time horizon. How much time do you have to reach your financial goals? Is it tied to retirement? Is it tied to your kids going to school and all those types of things? And again, I think, we go also and we think about, what are your investment goals? What are your investment goals? What's your goals for this money? And that's where my second question comes in, is what do you want this money to do? So, where did money come from? What do you want it to do? So where did money come from speaks to the opportunity cost, right? And what do you want the money to do speaks to the investment goals. And when do you want it to do it speaks to the time horizon. And I think those are the 3 most important parts of that conversation. And once we know that, now we can start to drill down and talk about what is your risk tolerance. I know for me, I don't like to lose money. I don't like to lose money. That's why I don't bet, and those type of things. So I have a very low tolerance for risk. And so not completely conservative, I'll take chances. I'll invest money. I'll invest money in myself, my own business. I'll invest in even even my children's business. And you guys saw my daughter on here a few weeks ago when we were talking about credit, Adrian, and if you need someone. And one of the things too, I'll tell you, if you contact Adrian about your credit, she's going to be honest with you. She's not just going to take your money, but I invest in her business. And so I invest in businesses that I think will produce return. But when you do that, I'm not looking for it right back. I know and understand I've been doing this long enough to know that it's a long-term situation. And so then my time horizon is a little different. My expectations are different. And I certainly want something that's going to definitely do better than inflation. And so let's talk a little bit about investment classes. And so there's different asset classes. For example, if you talk about a savings account, that's considered conservative. CDs, again, that's considered conservative. Not a lot of risk in a savings account, not a lot of risk in CDs. Most likely the bank is not going to go out of business. By the way, banks are the largest purchaser of insurance in the country is banks. And then when we get into annuities, now annuities can be a little bit tricky because there are certain kind of annuities. There's really three main types of annuities, what we call a fixed annuity. And that's where you got a very stable rate. Annuities are great for creating lifetime income. And then you have variable annuities. Variable annuities are more tied to stocks, mutual funds. We call them variable accounts. So they contain a little bit more risk. And then we have really what I think is the sweet spot in between, which is called fixed index annuities, where now you get the benefits of a fixed account, but yet you get the indexing of the securities market. And so there's different classes. Even within the annuity market, we love fixed index annuities because you get the upside of the market, but you don't have the downside risk. And then when you get into things like stocks, again, stocks become one of the more risky types of businesses or investments because, again, when you own one stock in one company, if that company goes belly up or as I overheard someone talking in Walmart today, if that company folds, right, then you can lose your money. Mutual funds, again, that's a little bit more safer than stocks and bonds or stocks in particular because now you own a bunch of companies, right? And so in order to lose everything, all the companies have to go bankrupt. Now you can lose value because that's what still makes it a little risky. But again, it's safer than stocks. And then bonds are safer than both mutual funds and stock because you have some guarantees. You have a bond issue, you buy it at a discount, it's going to pay a certain interest, municipal bonds and those type of things. And then, of course, we come back to real estate. Real estate, again, is one of those things that it can be a little tricky because, again, if you talk to a realtor, and I suggest that you do, is they always tell you location, 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 right? So is that property, how is that property going to be evaluated? Is it going to go up in value or is it in a depressed area that's going to go down in value? What is the rental value? If you're talking rental property, if you're able to flip it, what is it going to cost you to fix the home up and then turn around and sell it? So to me, you got to really know what you're doing when you start talking about real estate. And I've spoken to some of you. I know you're great real estate investors and that type of thing. And then we have commodities, things like gold, silver, those type of things are pretty safe. The gold market, there's a lot of people that believe that you should invest in gold. And then you got Forex, right? Foreign exchange. That's another good one where you can make money because the exchange of currency. And then you have private equity hedge funds, which are a little bit more risky because there's small groups that's going out maybe buying businesses and flipping them and those type of things. And then you got cryptocurrency. And really, when we get down to it, when you start looking at those things, I think you got to follow your passion. You got to follow your passion. You got to do your homework. If you're not passionate about real estate, if you don't have the stomach for it, then you got to realize you're going to have to invest in a property manager. Because if you don't want to be putting people out, you don't want to be taken to court. If you don't got the heart for that stuff, then you either are going to have to hire it out or maybe not do the real estate investment. Same thing with stocks and bonds. If you're a person and you buy stock and you're glued to the 6 o'clock news every night, wanting to see where it's moving, maybe that's not right for you. And so there's different types of things, and I like what I like the type of investing, the type of things that allow me to sleep at night. I don't want to be laying up in the bed wondering if I'm losing my money. And so, you got to take all those types of things into consideration. And so what I want to do is I want to divert a little bit and just give you a little bit of, some of the things that we teach. And so I'm actually going to, I'm going to ask Chris to pull up my screen, and you guys kind of let me know what's going on since I can't see the chat box. But here's how money works. So when we think about wealth, when we think about our retirement accounts, investments, we're usually thinking stocks, bonds, those type of things, mutual funds. And the great news is you can make a lot of money on the stock market. I mean, the truth is that most wealthy people have some type of money in the stock market. They have something in real estate, as Marlon said earlier. So you can make a lot of money there, but you also understand it comes with high risk. The higher the return, the higher risk. Vice versa, the higher the risk, the higher the return potential, but also you also have the potential of losing. And unfortunately, especially in many of our communities, Black, brown communities in particular, what we do is when we have those hiccups and we see the market being shaky, we run completely away. And we'll open a bank account, we'll open up a money account, we'll go down to Wells Fargo, Bank of America, whoever you bank with, we'll put our money in there. And the good news is we're not going to lose that money. The risk is very low. But also, as indicated earlier, the return is also very low. And so you have two opposite ends of the spectrum, where on one side I have high risk and high return, and then on the other side I got a low risk but low return. And that's why we coach a concept called fixed index strategy, in which with the fixed index strategy, folks, what you're going to get is you're going to get the best of both worlds. So when the market goes up, you're going to make money, but when the market goes down, you're not going to lose any. Usually, these fixed index strategies are tied to some type of index, some type of market index. And on my next slide, I show you one of those, which is the S&P 500. The S&P 500 is one of the more popular indexes. We can watch it on the news. You got the NASDAQ, you got the Dow Jones, which is the Dow Jones 30. And then you have the S&P 500 and then the NASDAQ, which is mostly your mutual fund market. Now, S&P 500 is the 500 largest publicly traded companies in the United States. And really, many people feel that it's a better indicator of our economy than even the Dow Jones, because the Dow Jones is just the 30 largest public traded companies in the United States. Now we expand our sampling, if you will, to 500 companies. Now, here's a historical performance, right? So we know that usually with the market, we have these kind of dips and losses that happen every 10 years or so. It's been that way ever since the Great Depression. And so we know those things happen, and we can see here, this is 20-year period of time from 99 all the way through the end of 2019. The market went down for 3 years in a row, early 2000, 2001, 2002, 23% loss. Then the market started to come back up, and we get out here to 2008, and now we have a 38% loss in the market. And really, the market had really been on a historical run since then. And then, 2007 or 18 was a negative year. And what I tell people, when you see this, we know these patterns occur, but what you want to be mindful of is how long does it take to come out of this pattern? And so when in the early 2000s, it took 8 years to get back to where the market was in 99. And many people call that the lost decade, right? Because you went 8 years not make any money. And then we go back to 2008, it's there for a year, and then bam, it crashes. And it takes another 5 years to get out of that. And so when we string all that together, that's 13 years. And if you've ever been in an appointment with me, I talk about that. If I use this analogy, if I showed up at your house and told you I had a great investment for you, and what's going to happen in 13 years, you're going to break even. You'll be like, why would I do that? I might as well put my money in my mattress. I could cut a hole in my mattress and put it in there and do that. But yet, that's what people experience in many cases, because that's how the market performed. And of course, all this I'm sharing with you is before COVID-19. And so what we do know, and we talked about this last week, is that the $5.5 trillion that the government has injected into the economy was to prevent this from happening. Now, let's be honest, it's an election year. Everybody wants the economy doing well if you're in office, right? Because you can say, look at what we did. And so they take all this money and they inject it into the economy to try to prevent from having these long recovery periods. Now, it may be reflected in the stock market prices in some cases, but according to the Congressional Budget Office, they're expecting this thing to be 10 years for us to come back, for the economy to come back to being full strength. So then what do you do about this? What do you do to combat that? And that's where we bring in this indexing strategy. Again, looking over the same 20-year period of time, as you can see, when the market goes down, we're on the blue line now, right? So when the market goes down, you just move sideways. So then when we get out here to 2007 and 8, same market, same money, but you're now at 145,000 because you didn't have to deal with losing money, and the market crashes, you stay at 145,000. You don't lose any money. The market starts to go back up, you start making money again. And as you can see, it creates these wide gaps because, again, the key is you're not having these losses. And so I tell people, I'm just smart enough to believe the quickest way to go up is not to go down. And so that's exactly what we're showing everyday people like you and I how to do, how to be in a position where you're never moving backwards. You're either staying level or you're moving up. And so slow and steady becomes the winner, right? And, when we look at this, everybody loves to quote this guy, right? Warren Buffett. Warren Buffett said the number one rule in money is to never lose money. Now, the reporter asked him, well, what's the number 2 rule? He says, always refer back to rule number 1. And what I'm saying is that Warren Buffett and all his money and investment wisdom, if he's saying his number 1 rule is to never lose money, then that probably ought to make sense for us to kind of follow that advice, at least with some of it. And I'm not saying this is the right answer for all of your investment, because we believe in diversifying your investments, both from a risk standpoint and also from a taxation standpoint, as we talked about that last week. And so then how does this look practically? Again, this is one of the vendors that we use for indexing. And again, S&P 500 goes down 3 years in a row. What do you get with the fixed indexing strategy? 0 losses. And so while everybody else is standing around the cooler talking about losing money, you're just like, I didn't lose any. And so 0 becomes the new hero. And then we get down here to 2008. Boom, the market crashes, loses 38%. What do you lose? Zero. And folks, when we look at this over a 20-year average between 99 and 2019, we see that the S&P's averaged about 4%. If we throw in reinvestment of dividends and all that stuff, maybe 4.5 versus that same time period of 10.2 with the best indexing strategy we had. All of them beat the S&P, but that was 10.2. And so what am I saying here? This works for someone like me because I want to stay out of the red. And if you're like most people, you don't like going in the red. You don't like losing. And even when we look at 2003, and the market went up 26%, but you had to make up for the 23% lost the year before, and the 13% the year before that, and the 10% the year before that. And then the market starts to go up and it crashes again, right? You lose 38%. 2009, the market goes up 23%, but I got to make up for the 38% that I lost the year before. And so, all those are things that you have to take in consideration. And the last example I want to show you is this. If we had a crystal ball and we went back to 1999 and said, hey, listen, what are the best 5 mutual funds on the market? These are the 5 that would be there. And so how does this 10.2 compare to the 5 best performing mutual funds over the last 20 years? And boom, it'd be right there in the middle. 10.2, it'd be the 3rd best mutual fund on the market. And so my whole point here is that there are ways to protect some of your money so that you don't lose it due to the stock market and still make money. And really, that's the key. That's what we want to, really coach and show people. And again, I'm not saying that this is ideal for everybody, but for a lot of people, this makes sense. And so, so if you guys have said one before, you may have seen some of that. It might be a little repetitive, but I just wanted to share that with you, just to just get you thinking about this whole investment thing. And again, diversifying your risk and your tax treatment, because if we woke up in the morning and the market dropped by 40%, most of us would be like, wow, it'd be all over the news, CNN, Fox News, whoever you watch, right? Black News Network, it'd be all over the place. But yet we give up 40% due to taxes and nobody says anything. And so you gotta look at the whole picture, diversify yourself in terms of risk, diversify yourself in terms of tax treatment. And so, and it's always interesting to ask this question in the chat box, and here's why you guys can participate. Do you consider yourself aggressive or conservative or moderate? Put in the chat yourself from a risk tolerance standpoint, moderate, or do you consider yourself risky? I want to know what Marlon, come on onto the screen. Let's bring Marlon on. Marlon, do you consider yourself aggressive, conservative, or moderate? What do you think?
I've always been a little bit on the aggressive side, but that was when I was younger. I would say that now, though, I'm a little bit more moderate. Yeah.
Okay.
Yeah. So that's what I would say. I think it's changed, but definitely when I was younger, man, I was like, yo, let's just roll it up. Let's roll, Jack. You know what I'm saying? And you roll the dice, man. But I really like what Warren Buffett said, right? The rule to investing is, don't lose your money. And I lost a lot of money in the stock market, right? The tech bubble, the real estate bubble, but I learned. And so I've taken, like your advice, and with this IUL, doing things where, what zero is a new hero, right? And then I think the other thing, Tony, that you're really masterful about is, the tax implications. I think that's really big, and so I think that for all of our viewers, and I see people, conservative, moderate, extremely conservative, then you really want to talk to Tony. And the thing is that, because again, if I knew better, I do better. I wish I had known about this, Tony, that you've been sharing, the red line, blue line, because if I had known 30 years ago, my goodness, my life, it'd be so much different, not to participate in those downside, when the market loses, right? And so, yeah, again, one of the things I want to do, and, we have a very special webinar this Thursday, we'll talk about that, because I think it's very important that we understand that wealthy families, they create legacy wealth, generational wealth, because they're using strategies like what Tony's talking about. And so, if we could, I was just going to say
this, and we'll bring up that. But I want to do this, Marlon. One of your favorite investment principles. What is it? I know what it is.
One of my favorite investment principles. My goodness, brother, you got to help me out.
72, right?
Oh yeah, the rule of 72, most definitely.
Rule of 72, right? It's one of your favorites. So how does the rule of 72 work?
Yeah, the rule of 72, basically, if you divide 72 divided by the return on your money, let's say you get an 18% return, right? And 18 goes into 72, how many times? You can type in the chat box, right? Well, I'm not going to wait for the chat box. So you guys know 4 times. Right, brother, break it down, right? But 4 times. So 18, you get an 18% return on your money. Check this out. 18% return on your money. 18 goes into 72 4 times. That means if you get an 18% return on your money every year, annual, every 4 years, your money will double. Okay. And when I got introduced to that when I was in my 20s, and I was like, oh my goodness. Right. And of course, back then, interest rates were higher, return on your money was better. Right. But there are investments, and that's what Tony's talking about. But check this out. So let's say you get a 4% return on your money, right? 4, right? 4 goes into 72 18 times. So that same dollar, right? It would take now 18 years for that $1 to turn into $2, right? Another 18 years, 36 years total for that $2 to turn into $4. So the ROI, rule of 72, is so huge. And so thank you, Tony.
But here's the thing, I want to just point this out, man. Check it out. So a lot of times when we're doing things like rule of 72, we're saying, what's the average, right? So we average, if we're averaging 8%, and you average 18%, your money doubles in 4 years and that type of thing, right? But, okay, so you're averaging, you're going 18%. And then what happens is if you're in the market and now you run into a negative 20% year, it blows up the whole rule of 72 because you just lost money. It blows it up. And a great example of that, Marlon, is if you had $1,000, right?
Right.
And you earn 20%, right? So now you got $1,200.
Right.
So we said you got 20%, and now let's just say the market goes down and it drops, right? It drops by 50%.
Okay.
Now you have gone from $1,200 to what?
$600.
You've gone from $1,200 to $600.
Right.
Right. So now you got $600 left. Now the market goes back up 50%. Okay.
Right.
Market goes back up 50%.
Right.
So now let's just look at it. What has been your average for the 3 years? Your average for the 3 years has been about 6%. Right? Because you had a positive year for 20, and a negative year for 50, and then a positive year for 50. So that's a total, if you add that up, that's a total of 20%. You divide that by 3 years, you're about just over 6% average. But now your market was at 1,000, you went to 1,200, now you've dropped to 600, and the market goes back up by 50%. What do you have?
$900.
$900, right?
Right.
So when you look at that, because you're only gaining on the money that you still have in the market. Now, I can sell this to you as we're averaging 6%.
Right.
But what has been your real experience? Your real experience has been you actually lost 10% because real life don't work in averages.
In averages. Woo! Good night.
Okay?
And for those of you that are still on, I want to commend you for being here. That's huge. Go ahead, Tony. That's
so what I'm saying is life doesn't work in averages. So that's why you got to stop. You got to have the stop loss in there so that you never lose money.
Yes. Yes.
And that's how you really get ahead in the long run. So I just want to throw that out.
No, I'm glad you did, man. And look, bro, I mean, I just want to say, listen to this, because that knowledge, what Tony just said, I know we're, 8:54, right? So we're 54 minutes in. And that's why, sometimes you save the best nuggets of wisdom at the end. What Tony just said, I mean, think about it. We broke it down, right? You would say, oh, yeah, 6% return average. Oh, that's great. But really, you just lost 10%, right? Because we don't operate in average. That's huge, right? And so that's what, look at this. Chad said, setting up my retirement with Mr. Jackson. That's powerful. My retirement, right? That was a person that had a one-on-one. Here we had James Crawford said, my time with Tony was definitely worth it. And I encourage everyone to take advantage of it. Yes, it's complimentary. That's the commitment we've made to BCG, to JD and Shelly, right? But this is our ministry. This is what we're doing. I mean, this is where the trajectory of families, by us sharing information like this, your children, your grandchildren, your great-grandchildren, man, they can be set. And then I love what Pam said. Check out, Pam said, yes, extremely insightful time I had during my intake with Mr. Jackson. Looking forward to session number 2. He is the maestro of finances. Come on, somebody. All right. I like that. That's cool, man. That's cool. Right. And so that to me is so important. And, those are just 3 of the people that have shared. And what I'm saying to you is that this is what we are offering. So again, info at The Real Money Coach. And I want to encourage you, listen, family, you guys are still on, you're here, share with your family and friends, right? I mean, you just heard, I love what James said. Hey, I would recommend. Well, let's pick up the phone. Let's call our family and friend, even if they're not involved, with the BCG. You listen, one of the things about me is I want to share things with my family and friends, right? I mean, I get it. Tony watches, University of Michigan football, 3.5 hours of his life. That's his thing, right? I ain't got time for no football game, right? All that time. Super Bowl. I watch the Super Bowl because that's, it's like a commercials and it's, it's like a annual thing. But my point is that so many of your family and friends are not here right now. And so, just think about all the family and friends who are suffering, or even those that think they got it going on. The next COVID, the next real estate, the next financial crisis, the next war, whatever it is, right? You want to be prepared. Zero is the new hero. So again, info at therealmoneycoach.com. And then Tony, I want you to talk about what we got coming up on Thursday, because I want to have a special invite.
Yeah, we want to do it. Let's flash the screen up real quick, Chris. I just want everyone to go to this page when we're talking about real estate. But we have a page in your book, and it just gives you the risks versus rewards. So please make sure you check that out. In your book, it'll be a page just like this. Talks about the risk, affordability, leverage, acquisition costs, liquidity. The rewards is, again, leverage, equity growth, income, tax benefits. So please make sure you go and unpack that out about the real estate. But check it out. On Thursday night, many of you come to our town hall meeting. We bring phenomenal guests every week. I'm just amazed at how really blessed we are to have some really dynamite people that join us. Some of you may need to come as our guests on Thursday night and share your expertise. But this month, the month of September, is Life Insurance Awareness Month. And we've had some phenomenal guests come on. We had Sandy Griffin come on. We had Brandy Bridget last week, and her story is very compelling. And now we're gonna bring next week. We're gonna bring owner of the brokerage that we work with, Phil Gerdinger, gonna come on and just talk about what we're doing to change the face of insurance, so that it looks like Marlon and I, right? So we're changing the face of insurance. We really want to bring a very high level conversation about life insurance. Now, here's the thing, folks. I got to tell you, this ain't your grandfather's life insurance, right? This ain't your grandfather's life insurance. You know, this is totally different. The complexities that's in it, the things that you can do with it. And the fact is that most of all of this is allowed by the IRS code. All of it is, man. There's a couple of IRS codes that allow you to do some things with life insurance that you can't do with any other investment. And this stuff has been around for years. It's not new, but we just haven't always been aware of the game. Do you realize it wasn't really until, I think it was something like in the 1950s, maybe 60s, that that life insurance was even available for our community, for the African American community, right? And so we've been way behind in this game. And you know, when you think about insurance going all the way back to Lloyd's of London, I mean, it's been around for hundreds of years, but we haven't even been in this game for 100 years. I mean, just really 50 years, 70 years, not even 75 years that we've been allowed to take advantage of these tools. And even with that, how many of us don't know what's available and what we can do with it? And so just join us on Thursday, same channel. You can go to The Real Money Coach on YouTube. By the way, if you have not subscribed to our YouTube page, please do that. Your numbers matter. It's like voting, right? It's like your vote matters, right? You liking us on Facebook, you subscribing to our YouTube channel matters. And so please join us on Thursday, and you won't be sorry. You're going to get a wealth of information that you can take and put into action. Wow. So Marlon, wow, that hour went by fast.
It sure did, man. Thank you, brother. I mean, you really dropped the knowledge tonight, and I can see your passion, your excitement. And, you know, one of the things I do want to say, you know, you look at what John Tour said, you know, I've been doing it all wrong. And, you know, John Tour, listen, you know, if we knew better, we'd do better, right? Or I'm sorry, John too. But go ahead, Tony.
This is what I want to say, especially John too, right? Is that, hey, Lorenzo, thank you for being here. We had a great conversation together. This brother is from Detroit. He's a Michigan fan too, all right? I guess you're saying it, all right? Right. We're being here, Mr. Ragland himself, my Detroit homeboy, right? But here's the thing that I want to say is that you haven't been doing it all wrong. It's just, it's incomplete. And so what we try to do is just complete the circle for you. Because what we've done is we've done according to what we know. Everybody, you haven't done it wrong. It's just, we just want to complete the puzzle, right? And so, so don't ever beat up on yourself. It's not that you've done it wrong. It's just we haven't had the complete story. And and I've always said this: as long as I know the rules of the game, I can play. All I got to do is know the rules. The problem is they keep changing the rules in Columbus. But anyway, that's a whole nother story. But as long as I know the rules, I can play the game. Yeah. And so that's important, is that we try to bring rules and knowledge to you. What my prayer is this, Marlon. Every time I meet with someone, I pray that I'll be able to share something with them that they didn't know before. If we never do business, I hope I gain a friend, and I hope I share something with them that they didn't know before. If I've done that, I'm out. Drop the mic. That's all I want.
Right, man. That's powerful, man. I mean, listen, time is so precious, and you can see Tony's just like a walking encyclopedia. So I want to say, you know, thank you. Thank you for being here. You know, you look at, you know, John too. I just want to put it back up. You know, John too, thank you. I've been doing it all wrong. No, man, you're in the game. We all can raise our hand and say, if I had only known back then what I know now, how would my life be different? So, I just want to say thank you. And I love, listen, I love what James said. It's all about networking. It's all about getting information, right? It's not about, what you know. People say, oh, it's who you know. No, it's who knows you, right? And so the fact that, you see Tony just lights up because he feels like this is a family right now, right? He's met with many of you one-on-one. And for those of you who haven't connected, send an email to info@therealmoneycoach. And I want to encourage each one of you, within the next 48 hours, encourage at least 5 people to schedule their appointments with Tony. You can go to TonyJacksonAppointment.com or send an email to info@therealmoneycoach. Because again, so many people are struggling. I'm telling you. Now they're saying 200,000 people have died of COVID. My question is, how many have their financial house in order of that 200,000 Americans that died this year, right? How many have their financial house in order? The majority don't, because the Wall Street Journal said 78% of all Americans are living paycheck to paycheck. Let that sink in. 78% of all Americans, regardless of income, are living paycheck to paycheck. This is alarming. And 50 million people have filed for unemployment.
You sparked something else I just want to mention. And I know this is happening. I've seen it. I don't like the tactic, right? I don't like the tactic people say, well, you better do this because you don't know, you might, life insurance agents particularly like saying you might step out of the house and be hit by a bus. All right. Yes, that's possible. It doesn't happen very often. But I'm telling you, I've been in this business long enough to know, and we're starting to see it. The approval ratings are going to start, the underwriters are going to start tightening up, because you can't have 200,000 people die in one particular disease within a 6-month period of time, and they not tighten up the underwriting on that. Because I mean, it's just going to happen.
Right.
And so what I'm suggesting to people now is take advantage of it. Get in while you have your health, and before it all tightens up where it's going to be hard to get. So when you said that, it just kind of really sparked that thought in my mind. Is like, it's not about you maybe getting hit, but it's a matter of taking advantage of your health, taking advantage of the opportunity now. Just lock it in. I mean, where you start is not have to be where you end, but lock it in now while you can.
That's right. That's right. Thank you, Tony. And the thing is family, one of the things also, it's a strategy. I don't know if you know this, but Walt Disney used cash value life insurance to fund Disneyland, right? Have you heard of James Cash Penney? Okay, James Cash Penney is J.C. Penney. He used, cash value life insurance. Ray Kroc, when he wanted to buy out the McDonald brothers, to have McDonald's, he used, what did he use? Cash value life insurance. And so there's many other people. So what I'm saying, these individuals use it for business. We're talking about investments. I mean, what I want you to understand is, and that's why I wanted to really harp on, I appreciate, John Two's, message. I've been doing it all wrong. No, John Two, you did the best with what you knew how. And that's why the Real Money Coach, we're so committed to saying, I'm telling you, the way wealthy families are creating legacy wealth is not because they're smarter than anybody. They have access to information and they take action straight up. And so that's why, for me, this is a ministry, it's a mission. And, and I love, what, Clarion said, I'm sorry, what is it? Clarenzo said, I'll be tuned in on Thursday. I want to encourage everyone to share with your family, your friends. We'll be on the same, bat channel, same bat time on Thursday night. Please put the slide back up one more time, because I want you to understand this is a game changer. This is a game changer. Life Insurance Awareness Month, right? And so we're going to have Phil Gerlicher, Ron Wheeler. They have over 75 years of experience in life insurance in the industry. And so you can see I'm really passionate, because let me tell you something. Okay, that's this September 24th, Thursday at 8 p.m. Eastern. Same, bat channel, right? The Real Money Coach. Let your family know. Let your friends know. Why? Because it makes a difference. It makes a difference. And listen, you can use this, as Tony said, the time when you want something is when you don't need it. So actually, I'm using this as a vehicle. We have something called the $1 Million Baby movement, right? Where we're helping young kids and millennials and teenagers, right? So again, you can use this as a strategy. That's why I'm talking about Walt Disney and J.C. Penney, right? And Ray Kroc. These are very successful business owners that use what we're talking about.
Right.
And so to me, go ahead, Tony.
I want to say this too, man. I hope you don't I hope people don't misinterpret our passion for this as like, just sell. We're gonna push something down your throat. But because it's not for everybody. And it may not be for you. But what we believe is this: we believe that there's enough benefit in it to explore it. And that's all you do is exploring. And if it makes sense for you, it does. If it doesn't, it doesn't. And I'll be the first to tell you, if you shouldn't have this, I'm gonna tell you you shouldn't have it. Sure. Because we have policies that have all the bells and whistles, and you can put from hundreds to $1,000 in it. And if I believe that that's not right for you, I'm gonna tell you, hey, listen, you need to do this $30, right? Because that makes sense for your situation. So everybody's different. There's no cookie cutter approach, or there's no cookie cutter solution, and there's wisdom in a multitude of counselors. So we're just pumping tonight.
Thank you, Tony. So with that being shared, we're going to go ahead and close out. We'll hope to see you Thursday, right? We hope that you'll, have some of your family, your friends, connect with Tony, info at The Real Money Coach. Why? Because time is so precious and tomorrow's not promised. And I know that you've had a great time. Type in the chat box, what did you learn tonight? Did you enjoy? Was it worth your time? I know we're right now a little bit over. And so we're going to go ahead and conclude. But was this worth your time? Just, yes or no. What did you learn? Did you enjoy? Type it in the chat box. Because what I want you to understand is what you do today will dictate where you'll be tomorrow. Straight up. And so we are so grateful to be part of this movement. The Real Money Coach movement in partnership with BCG, Black Couples Getaway. And we're looking forward to next week, next Tuesday, we talk about entrepreneurship. You see, I get excited because I really believe everyone should have their own business. I truly do. So I am Marlon Smith in partnership with Tony Jackson and Chris Jackson. We are the Real Money Coach. And remember, a vision without action is just a dream. A lot of action without a vision is merely a passing of time. But a vision, come on, someone, a vision with action can change the world. You stay blessed, keep on keeping on, because there's greatness within you. And thank you so much for being here. Stay blessed.